Hello, my dear friends. Very good morning to all of you, and welcome to day 7 RPL discussion on FR. I hope my voice is audible and the PPT is visible. Can you please confirm it once so that we can move further on this? Okay. The voice is audible, very nice. And again, I hope the internet stays. Being a Sunday, a lot of load would be there, so please try to cooperate. Okay, let us go further. We were discussing on standards related to assets. We did Ind AS 16, plant, property and equipment. We did Ind AS 2, which is inventory, and also we did leases earlier itself. And now it is the time for next standard, Ind AS 23, which is borrowing cost. Now, borrowing cost. First of all, how to remember the number standard borrowing cost? You know, in English, A for 1, B for 2, C for 3, borrowing cost BC. So Ind AS 23 is borrowing cost. As simple as that. Let us do a summary of it. So what does it include? It includes interest. Any income earned will be subtracted, and even charges, that is interest, financial charges under Ind AS 116 or financial lease, that interest cost will be there. That is also considered. Amortization discounts, that is whatever discount on issue of debentures, all those things are also considered. And even foreign exchange difference, to the extent in the nature of interest, is also part of it. This is important. We will do a problem on that. Type of borrowing may be specific borrowing or general borrowing. Specific borrowing means a loan taken only for the purpose of this particular project, therefore we take that particular rate of interest. And if it is general borrowing, many borrowing will be there, so we'll take a weighted average. What do you mean by weighted average? The amount of loan into the rate of interest plus amount of loan into rate of interest, and so on, divide by total amount of all borrowings. And the purpose and the period for which it is utilized, only that period interest will be capitalized. Accounting treatment, it is capitalized provided asset is a qualifying asset. It might be for the purpose of purchase of the asset, it might be for the purpose of construction of the asset, but the asset must be qualifying asset. And what is the qualifying asset? Substantial period to get ready for use. Whether purchased or constructed, it should take substantial periods. And normally 12 months, not always. So if the question says 9 months, 6 months, you write an assumption. Institute, sometimes they have taken as non-qualifying asset, sometimes as qualifying asset if it is less than 12 months. IFRS Ind AS don't give the term 12 months guidance. Accounting standard gives this guidance. Ind AS don't give this guidance. So in the examination, if it is less than 12 months, you can make an assumption and accordingly you can solve it. You are absolutely right in that context. And very easy to remember. You know that relating to the asset which is qualifying asset only will be capitalized. And what is qualifying asset? Substantial period to get ready for use. You know, once you pass CA examination, what are you called as? You say, I'm a qualified CA. Why are you called as qualified? Because you take substantial period time to get ready for use. I'm sure you understand the meaning of substantial period. A person who does 10th standard, a BCom, will not be saying I'm a qualified BCom. But for a CA, you say I'm a qualified CA. Why? Because you take substantial period to get ready for use. Now, cutoff date, whenever the asset is ready for use, you are going to capitalize it. And exchange difference with respect to AS11 or Ind AS 21, we need to connect it. That portion we'll discuss separately. That is an important point. This is the simple summary of it with respect to Ind AS 23. Not many complications are there. Only word to remember is qualifying asset, and all types of interest and cost is part of borrowing cost. And if it is not for a qualifying asset, that expense will be charged out to P&L. Relevant for foreign exchange, we have to discuss. Before that, if you have any question up to this point, please ask. Are you covering all AS related to old syllabus? No, I have explained a number of times in my introduction video also and the day one video also. All AS is not covered. For more clarity, what standards are covered, what topics are not covered, please refer to my intro video, not the revision video. Before that, I had released about 6 to 8 minutes, I think, maybe 5 minutes. That revision video, introduction video, you please go through it. I have discussed there what topic is covered, what topic is not covered. Okay. Any other question so far? If you have anything, you can ask. And after this, we'll go to the important segment, that is foreign exchange versus borrowings. Will you provide this summary chart? I'm not providing summary chart in general, but whichever specific chart you want, you can request in the group. I will share it as specific charts. How to remember this standard? The standard remembering is very, very easy. In English, A for 1, B for 2, C for 3. B for 2, C for 3. Borrowing 2, cost C 3. So borrowing cost BC. So Ind AS 23. Okay, hope things are fine. Let's go to the most important, the foreign exchange difference. This standard is more specific for Indian level companies or developing companies, because this situation would arise only in these type of economies. First point, suppose if you take a loan in rupee terms, let's say a bank is charging you 18% returns, rate of interest. Now it might have been followed. Let's say that this is what is charged by bank. Now, if you take the loan in dollar terms and then you can convert it to rupees, that you can always do. But your original loan is in dollar terms. In dollar terms, you know the rate of interest is not 18%. They are having a cheaper rate of interest. Let's say it is 8%. Let's say it is a 8%. Now, at the end of the year or on the reporting date, as per AS11 as well as Ind AS 21, the effect of changes in foreign exchange rates, you have to reassess the monetary items which is loan. That is basically whatever the closing rate as on the year end date, you have to adjust for it. Foreign exchange gain or foreign exchange loss. Let's say the rates have increased. What do you call in foreign exchange when the exchange rate increases or when the currency is trading at a higher rate? When the currency is increasing, what do you call? It is trading at premium. For example, the premium is happened to be, let's say for simplicity's sake, 4%. The premium happens to be 4%. Now that 4%, can you tell me, is it a loss or a gain in this transaction? You have taken loan in foreign currency and the currency rates have increased. Premium of 4%. Increase, premium of 4%. Is it a loss or a gain from the borrower perspective? Can you comment? Is it a loss or a gain from the borrower perspective? It is a loss because borrower has to pay more, right? Borrower has to pay more, therefore it is a loss. Now, why this loss is occurring? This loss is occurring because you're taking loan in dollars. Had you not taken loan in dollar terms, had you taken the loan in rupee terms, then also you would have paid interest. So this loss is attributable to borrowings. This loss, this expense, this cost is attributable to borrowings. This cost is attributable to borrowings. Therefore, what is the standard name we are discussing? Borrowing cost. We are not discussing interest cost. We are discussing borrowing cost. So, borrowing cost includes the interest expense? Yes. Does it include this foreign exchange loss? Yes. Because this foreign exchange loss is attributable to the borrowing, therefore this loss is to be reported as borrowing cost. Hope you got that point till there. Now suppose it is not 4% premium, happens to be, let's say, 12% premium. Happens to be 12% premium. Now, how much is attributable to this? Please understand, approximate basis. This total is 18%. This total 8 plus 12 would be 20%, which means you are incurring 2% extra because you are borrowing in foreign currency dollars. But had you taken the loan in rupee terms, you would have paid only 18%. Now you are paying 20%. 2% extra you are paying is not attributable to the borrowing, because according to borrowing it should only be 2%. It should be only be 18%. 2% extra you are paying is not in the context of the interest. It is in the context of the foreign exchange transaction. Or one more concept in SFM, you would have learnt the concept of interest rate parity theorem. What does interest rate parity theorem says? You are indifferent to borrow in one country or to invest in another country. You don't have any advantage. Whatever advantage you see in one market will get compensated in another market. That is what IRPT theorem says. If IRPT theorem don't hold good, then we go for saying that, okay, one country is cheaper to borrow, other country is costlier to invest. I'll try to do some selection. I'll try to do some arbitrage. So, this is the background which I would like to connect. Now, what are the steps to be followed in foreign exchange difference calculation as far as borrowing cost is concerned? Step 1, you compute what is the foreign exchange difference, which usually will be loss. Second step, you compute the savings in foreign borrowing. How do you compute the savings? Point A, interest on notional rupee loan, and second, actual interest on foreign currency loan, on dollar loan, let's say. Now this difference is the savings. But is it your savings? No, you are not saving. Then where you are losing? You are losing in foreign exchange difference. Suppose your foreign exchange difference is 20,000 rupees. This difference happens to be 15,000 rupees. So 15,000 is not your savings. You are losing. Where you are losing? In foreign exchange. So 15,000 you report as borrowing cost, and balance 5,000 you report as actual foreign exchange difference. So 15,000 will be reported as Ind AS 23 or AS 16. 5,000 will be reported as Ind AS 21 or AS 11. So 15,000 also will be an expense, 5,000 also will be an expense. Now one more question come, do we capitalize this 15,000 or do we take it to P&L account? That is not covered here. That is the dependency on qualifying asset. If this asset happens to be a qualifying asset, this interest will be capitalized on substantial period basis. Otherwise, this will go to P&L account. So whether you apply this portion or you don't apply this portion, ultimately this will go to P&L account as an expense. But the reporting matters, my dear friend. Whether you report as a foreign exchange loss or you report as an interest cost, cash flow activities might be have an impact. Your EBIT will have an impact on valuations of companies in SFM, mergers, investor share prices. So many places are having an impact. So on the reporting point of view, this is relevant. Let us do a problem in this case and then we'll go for the next point. Okay, this is the problem. This is the summary chart. You first find out difference in principal liability, interest on Indian rupee loan minus the actual interest. Savings I told you will be reported as Ind AS 23. Remaining will come to foreign exchange difference. And if this saving happens to be more, we don't adjust for any savings. We limit ourselves only for the amount of exchange loss. We don't create any gain. Anyway, that point I'll come to it later. I hope you got the logic as well as the steps. Let's do a problem and then you can ask your question. Sun Cooperative Society Limited has borrowed a sum of 12.5 million at the commencement of the financial year for its solar energy project at LIBOR 1 plus 4%. The interest is payable at the end of respective financial year. The loan was availed at then rate of 45. At then rate means beginning. And while the rate on 31st March 2012 is 48 year end. So 45 has become 48. So 3 rupee is the foreign exchange loss. Had Sun Cooperative Society Limited borrowed the rupee equivalent in India, interest would have been 11%. This is notional had you taken in Indian terms. You are required to compute the borrowing cost, also show the amount of exchange difference as per prevailing accounting standards. Now, first, as I told you, compute the foreign exchange loss. So 48 minus 45, that is 3 rupees I told you. Amount of loan borrowed 12.5 million, 37.5. Interest, I told you second step is to find out the savings. Savings don't write in exam, it's only for our reference. Interest what you're paying now versus interest had you paying on a notional basis. Interest on rupee equivalent loan 12.5 into 45, that was the beginning rate, and Indian notional rate of interest would be 11%. You would have paid 61.875 million as loan interest had you taken the loan in rupee terms notionally. But what actually you have taken? 12.5. How much rate of interest payable? 5%. What is the rate of interest? What is the conversion rate today? Because interest to be paid today 48, that comes to 30. So notionally you would have paid 61, but actually you are paying 30, so you are saving 31.875. But it's not really a saving because this saving you lost as a part of exchange difference. So this you report it as borrowing cost, don't report it as the exchange difference, and balance only you will be calling it as exchange difference. So out of 37.5, we are going to report the borrowing cost as 31.875 and foreign exchange loss of 5.625. So this is what is all about. So if you have any question up to this stage, you can please ask, else we'll go further. Foreign exchange gain ignored? Yes. We don't consider any foreign exchange gain. If it is foreign exchange gain, that is a gain. There is nothing to report as borrowing costs. Gain is gain. Okay, I think things are fine. We can proceed. Okay. Let's go further then. Okay. In days 23, any other area important? Foreign exchange is important. You need to very careful about the general borrowing weighted average cost of interest. That would be it, I think. While computing the weighted average part, you should be careful. Apart from that, this is a very simple standard. Okay, let's go further on next standard, intangible asset, Ind AS 38. How to remember this standards? Cessation, capitalization and all. I told you, cessation, once the asset is ready for use, you stop it. If it is active development is interrupted, you suspend it. There is nothing else beyond in this standard. Once the asset ready for use, you cessate, you stop capitalization. Problem has another required also in the last line. Okay, if the rate of interest was 15% instead of 11%, okay, how would your answer above question? I think that was not intended. Anyway, let me just explain that. What would have happened if this was not 11%, if this was 15%? What would have happened? Okay, let me calculate quickly. It would be 84.375. So this number would be 54.375. So if I wrote it as 54.375, you know what will happen? That will become a negative number. A negative number means foreign exchange gain. We don't want to report foreign exchange gain. We don't want to create a foreign exchange gain. Against prudence principle. Logically it might be, but we don't want to report it. We don't want to artificially create a gain. Therefore, what do? We limit this only to 37.5 and we will report it as 0. So if the difference, the savings happens to be exceeding the exchange difference, we limit ourselves for reporting only to the extent of exchange loss. We don't artificially create exchange gain. I hope borrowing cost is clear. Whichever is lower, yeah, you can say that. Okay, let's go further. Ind AS 38, intangible asset. How to remember this first? AS 26, Ind AS 38. See, Ind AS 38, intangible asset. You see the sounding Ind AS IN, Ind AS intangible asset, AS asset, AS Ind AS intangible sounding, and end also 38 asset. You understand the sounding? Listen to your own words. 38 T asset T. So starting point is I, last letter is T, last letter is T. Intangible, Ind AS sounding asset, AS asset. So sounding is similar, words are similar, beginning letter, end letter is very similar. You should remember Ind AS 38 is intangible asset. Okay, now intangible asset means it is identifiable in nature, meaning it should be capable of being separate, it should be visible. If you can't separate it, then you cannot call it as an intangible asset. And then non-monetary means not monetary. What is monetary? Fixed or determinable amount, because intangible asset cannot have a fixed amount. And it should be an asset. It's a resource controlled. Resource control means power to get benefits or restrict not to use others, like for example trade license or patents, or you have a logo, trademarks, others cannot use it. That is your benefit. So either you use it or you restrict others from using it. That is a resource controlled by you, having future economic benefits and as a result of past events. And not a physical substance, therefore it is not visible. Can you tell me, my dear friends, various example, franchisee, license, goodwill, patents are also example of intangible asset. Is CA degree your intangible asset? Can you please confirm? Is CA degree is your intangible asset? Is CA degree your intangible asset? Okay. First of all, no physical substance. Yes, it does not have physical substance. Do you have a benefit? Yes. Is it a resource you are controlling? Yes. Degree you control. But is it a result of past event? Yes. Many events before you get degree. It is non-monetary, yes, but is it identifiable? The answer is no. You can't sell the degree. You can't separate it. See, goodwill along with business you can sell. Patent you can sell. See, a degree is not a tradable asset. You can't convert it to, you can't sell it to somebody else. So it's CA firm having goodwill, that can be, but individual degree cannot be sold. Maybe in future that also may come, we don't know. But as of now, that is not being capable of separated. Therefore, it is not an intangible asset. But in general, yes, to understand, yes, you can say that. Okay. Recognition principle, same definition as earlier. And what expense cannot be capitalized? The startup cost, expenditure on research, training expense, advertisement cost are not capitalized. Pay more attention to advertisement cost. A popular question in examination and a popular requirement by clients also. I have witnessed this so many times from my clients, that I've spent so much of money on advertising, marketing, sales, promotion activities. Am I developing goodwill? Can I capitalize it? I'm able to get the benefit out of it, and can I defer it? No such things. Advertising expense, sales promotion, distribution expense are clearly to be expensed off. Logically, they might have benefit, but accounting wise, we need a strong connection which we don't have. Therefore, that cannot be capitalized. As per the definition of goodwill, also not intangible, as it cannot be sold separately without selling business. No, it can be. No. When I say separated, in the business you can sell. Don't read that word literally. Cannot be separated does not mean that it has to be sold individually. It should be capable of being sold. That is the meaning of it. Along with the business, it can be sold. So it is an intangible asset. So if you have four business and you say that business for a consumer division, business for software division, you can say goodwill for those divisions. You can separate it then. Separation means understand from that angle, not literal separation. Startup cost, primary expense, similar. Yes, startup cost, primary expenses, those things are not to be called as intangible assets. They are fictitious assets. They have to be charged off to P&L account. They cannot be even deferred. They have to be charged off to P&L account. Any other question? If goodwill is intangible, why shown separately on the face in the Ind AS and not along with intangible as per Schedule 3? That is reporting part. It is definitely an intangible asset. But the thing is, the measurement principle under Ind AS 38, we don't apply to goodwill because we don't compute goodwill directly. We always compute as a balancing figure. So goodwill computation is not done as per Ind AS 38. Goodwill calculation is done as per Ind AS 103. Therefore, it is separate from other intangible assets. Therefore, it is reported also separately. Goodwill is one special asset. It can never be computed accurately. It's always computed as a balancing figure. That's why. Okay. Hope it is fine. Okay. Let's go further. Recognition of an asset by separate acquisition. When you acquire it separately by paying an amount, that we say that usually transaction price is equal to fair value. That is a regular assumption. As a part of business combination, that is basically part of goodwill, purchase consideration minus net assets. That is for goodwill. And others, as a part of business combination, you take over intangibles, patents, license also you take over. By way of government grant, if you get the government grant, that is if you get a license from the government free of cost or a concession rate, you can create government grant. How? You can debit intangible and you can do to government grant if it is free of cost. Concession also similar way. Exchange of asset, same as Ind AS 16, what we discussed, that is commercial substance, and then you go for fair value of the asset acquired or given up, whichever is clearly evident. And from exam point of view, go for the fair value of the asset given up, and then you go for fair value of the asset acquired. Same thing. Internally generate goodwill, that is not recognized. That is because of the cost principle. Reliable measurement of cost cannot be there in goodwill, therefore it is not recognized. Internally generated intangible means research and development expense. Which expense to be recognized? We'll discuss it now. Internally generated intangibles, basically research and development expense. So what is the basic difference? Research means it is for the purpose of gaining knowledge. We don't know the output. Development means application of research finding. So if there is coronavirus, you are trying to find out a solution for it, a treatment for that, you do lot of studies. That is not to be called as development, that is a research, because you are still studying, you are getting knowledge, your result is not sure. In such case, it will be transferred to P&L account. Development stage means your study is over, result is there, you know that okay, now this works, and now after this works means you need to do some more activities. You need to set up the plant, you need to apply for the patent, you need to do some more legal proceedings, you need to apply for the legal applications. So a lot of things to be done, and once they give the approval, you need to keep your things ready. You start producing the goods, labeling will happen, lot of other expenses will be called as development expenditure that can be capitalized. But remember, you want to capitalize means you demonstrate there is technical feasibility, intention to complete, active market. This is important. There has to be a market for that, means this should be capable of being used. I will find out the formula which will come as a disease after 100 years. No, the what research you have done, what development you have done should be capable of being used today. There has to be an active demonstrated market. If you don't have it, you cannot capitalize it. And as a very simple example I always give, in this case in my regular class also, how to differentiate between research and development, like how to differentiate between knowledge and application. Tomato scientifically is a fruit. Tomato is scientifically is a fruit, but it should not be put it in fruit salad. Just because the knowledge that it is a fruit, don't put it in fruit salad. Similarly, there is one more saying, again only for understanding the concept, please don't take me in different context. A successful chartered accountant is the one who knows Income Tax Act perfectly. Then who is a great legend chartered accountant who knows the income tax officer more than the Income Tax Act. Anyway, the difference between knowledge and application is what? Is the difference between research and development. Knowledge is not capitalized, though required, because the future economic benefits cannot be established. Whereas development is application, future economic benefits can be established, therefore it can be capitalized. Okay. Measurement after recognition, the cost model, revaluation model applies. This is under Ind AS. Just like very similar to your Ind AS 16. But under accounting standard 38, they follow only cost model. They don't follow revaluation model. Is one of the biggest difference between AS 28 and Ind AS 36. The AS 10 was also old, but AS 10 is revised, which is same as Ind AS 16. But AS 30, Ind AS 38 is there, but AS 26 is not revised. Therefore, the difference between cost model, revaluation model, whatever are there, are all applicable to difference between intangible asset as per AS 26 and as per Ind AS 38. Okay, now cost model same, revaluation model same. Only point is amortization, systematic allocation, depreciable amount. You can include renewal period also. If the renewal fees is minimal, you can consider that also. Okay, this point is important. This point is important. Intangible assets with definite useful life. Intangible with indefinite useful life. This is definite useful life. This is indefinite useful life. Remember, indefinite does not mean infinity. Indefinite does not mean infinity. For example, you have goodwill. So how long the goodwill is going to be there with you? See, if you have a patent, if you have a franchisee, there is a useful life after which you have to renew it or you have to close it out. But goodwill, patents, which may not have expiry periods. When you don't have expiry periods, how do you amortize it? AS 26 assumes 10 years. Nothing more than 10 years can be assumed unless there is conclusive evidence. I think yeah, conclusive evidence should be there or persuasive evidence should be there under AS 26. But in AS, no. You say if it is intangible with indefinite useful life, you don't amortize, you just test for impairment. You don't amortize, you test for impairment. At the end of every year, you check whether those intangibles are impaired or not. Remember, indefinite useful life is different from infinite. It is not infinite, it is just that cash flow keeps on coming in the foreseeable future. As long as we can foresee that this asset gives the same cash flow every year, we are not having any issues for foreseeable future, you need not provide any amortization. You test for impairment every year. When does impairment applies? Whenever cash flow from that asset decrease or expected to decrease. Impairment happens, that impairment loss you take it. So on indefinite intangible assets, no impairment or no amortization, only impairment. Hope things are clear. A typical example is goodwill. Goodwill will not have amortization. Goodwill will have only impairment. Okay, amortization is same concept. Useful life is similar concept. Review should be done just like PPE only. Revaluation model, again same thing. You increase the asset, increase the liability, create revaluation surplus. It will go to OCI. On the event of recognition, it will never come to P&L account. Additional depreciation due to revaluation can be transferred retained earnings. All those concepts same, no difference as such. So we will go to problems, but before problems, if you have any questions, please ask. What is the difference? Both are charged to P&L. My dear friend, the objective of P&L is not to just to know the profit. If the objective was just to know the profit, they will tell you one line, no, net profit for the year. Why should they give you P&L account? So the users will understand how much sales, how much expense, what is the nature of the expense also. Even in the borrowing cost, the foreign exchange loss goes to P&L, the interest expense also going to P&L. Why do we differentiate? Reporting. The subject name is financial reporting. What is the purpose of financial reporting? It should be useful for the users to make a decision, make an economic decision. So amortization is a gradual decrease. Impairment is a sudden decrease. The nature of the expense matters, which give a indication. Therefore, that reporting terminology is important, not just the place, presentation as well as disclosure. So nature of expense, whether amortization or impairment, makes a lot of difference as far as investor is concerned. That's why. Shall we proceed further? Once more, amortization and impairment difference. We'll discuss in detail once more in next standard. In days 36, impairment we'll be doing. There, I will talk about impairment, what is depreciation, what is revaluation loss. Among these three, I will talk about it again in next standard. You will get more clarity regarding the impairment. And once you get the clarity there, this point will automatically be addressed. Why this speciality of reporting of impairment? Is it fine? Okay, done. Let's go to problem. Please read this one and tell me what is the useful life. Please read this question and what is a useful life. If you have read this is renewable every 10 years and it can be renewed if entity provides average level of service. The license may be renewed at little cost and it is also renewed twice. So it can be renewed for a certain period in future without any restriction and the broadcasting is not expected to be replaced. So cash flow will continue. This is a case of the intangible asset with indefinite useful life. It is a case of asset with indefinite useful life. Okay, now you read next one, next question, continuation of the same thing. If the licensing authority subsequently decides that it will no longer renew the broadcasting license but rather will auction the license, at the time the licensing authority decision is made, entity's broadcasting license has 3 years until it expires. The entity expects that the license will continue contribute to net cash flow until the license expires. So here what happens, so far things were going fine, but from now onwards there is a change that it is going to be auctioned done, so you will not get an automatic renewal. So 3 years remaining and after 3 years you may get, you may not get. So your assumption of indefinite useful life, now it is changed. So remaining useful life is 3 years. So whatever is your license fee amount was there, you should amortize over a period of 3 years. Asset which was indefinite asset, indefinite useful life, now because of this change became asset with definite useful life. Hope you got this point. Let us do one more problem relevant for this intangible asset. Please read. 1 second. Okay. NDA Corporation is engaged in the research on new process design for its product. It had incurred an expenditure of 530 lakhs up to 2010. The development process began on 1st of April 2010 and development phase expenditure was 360. So 530 was expense, research expense, and development expenditure 360 lakhs. So this is development expenditure. So research expense will be transferred to P&L account and development expenditure will be transferred to balance sheet. From 1st of April 2011, the company will implement the new process design, which will result in saving 80 lakhs per annum for next 5 years. The cost of capital is 10%. Explain accounting treatment for research expense, cost of internally generated intangible asset as per Ind AS, the amount of amortization of the assets. The concept of rebuttable assumption of 10 years is removed in Ind AS. Yes, it is not there in Ind AS. It's not removed. It is not there at all under Ind AS. It was never there. Only accounting standard we had it, but Ind AS we don't have it. Personally, I like that because some sort of expense transfer is good. But anyway, Ind AS don't have any such assumptions. Now, research expenses transferred to P&L accounts. Cost of internally generated intangible assets, development expenditure, capitalize, which is 360 lakhs. And this should be always tested for impairment. Impairment means you have to know the carrying amount, which is 360, and we have to compute the recoverable amount. For simple understanding, let's take it as fair value or present value. What is the benefit we get? 80 lakhs multiplied by, don't multiply it by 5 years. Present value effect has to be given. Therefore, you do the cost of capital 1 divided by 1.1 press equals to 5 times GT. I hope you know it. I think approximately 3.79, and I think this approximately comes to 303. Please confirm it if this is fine. Therefore, impairment will be 57. Yeah, 57. And therefore, amortization subsequently, not for this year, amortization subsequently is 303 over a period of 5 years, which is 60.6 per annum. Okay, hope you got this. That's all about intangible assets, Ind AS 38. Any other question before we go to the next standards? Every year impairment will be tested. Yes, every year impairment will be tested. Every year impairment in testing should be done every year. There might be impairment, there may not be impairment, but you have to test for impairment every year. Impairment, you are checking on the date of capitalizing itself. Yes, on the date of, once you capitalize, the next on the reporting date I am checking for impairment. Both happens to be same in this problem. Amount of development expenditure is capitalized, but remember, this expenditure will not happen on the last day of the year. This expenditure is incurred throughout the year. So capitalization is throughout the year, impairment on reporting date. Okay, shall we go to impairment in the AS 36? In development phase will be classified as intangible under development. Yes, it is. Your question itself has the answer. Development phase, it is intangible assets under development. Yes, correct. Okay, can we go to impairment in days 36? Development phase are over on 1st of April and we are testing on impairment the dates. Impairment testing is done on reporting date. Impairment testing is done on reporting date. Whether the asset is development or asset is completed does not matter. Impairment test has to happen. Even if the asset is under development, impairment test still need to happen. Okay, I hope we can move further. Okay, good. Impairment of assets. Now, impairment of asset, remembering the number, I don't have any specific thing. Maybe that whatever I think is 36 is the age usually where people start getting impairment in their life, because your life would have been settled and you would be having family also, you'd be having the family pressure also, professional pressure also, personal pressure also. So all kind of pressure starts at that age 36, your BP and all things starts. So I believe that is the age in which impairment also will start. Anyway, so you have to understand these three difference. Would you please focus more on this in days 36? Generally feel this difficult. I will spend what I am planning to spend. As usual, any area where you have the doubts, I will address it. Okay, first let us get the basics right. How do you differentiate between depreciation, revaluation loss and impairment? See, depreciation means using the asset, the value of the asset will come down. It's a gradual decrease because of wear and tear and using the asset. It's a normal loss. So when somebody shows depreciation in P&L account, they just understand, yes, asset is utilized, depreciation happens. It's very, very common, very, very normal. Now, revaluation loss means fluctuation in market value. So this revaluation loss is nothing to do with use of the asset. Revaluation loss is because of market value. So if somebody reports revaluation loss in their P&L account, it means the market value of the asset is undergoing a change and that is being reflected. That's it. It's just a temporary phenomenon, fluctuations in market price. But impairment means sudden decrease. Impairment means sudden decrease. It's an abnormal loss. For example, accident happened and extreme situation like let's say coronavirus happened and your asset now is becoming useless. You cannot produce the goods. The value of the asset which was supposed to reduce over a period of time suddenly reduced. It's like an abnormal loss. So when some people report impairment loss in their P&L account, that means some unexpected material negative event have occurred. An impairment of an asset may also indicate the asset is now getting over, now getting useless, so the entity may purchase new asset in the future. If they don't do, their business might be in question mark and going concern also may be affected. So this impairment, abnormal loss, sudden event has got that great impact. So has got that sudden great impact. Like you go to office every day, you have friendships, that is normal depreciation. Suddenly you get married, impairment happens, so it is that sudden depreciation. That is one abnormal situation. Anyway, only for example purpose only. But before we go further, did you understand the purpose of impairment correctly? It's an abnormal loss. And when impairment is in the Financial statements, it's a negative indicator for the investor to continue, because that reflects a serious issue. Impairment is a serious issue on the asset, of course, not may not be on the business, but on the asset. How amortization is different from them. For tangible assets, we use the word depreciation. For intangible assets, we use the word amortization. So for understanding purposes, depreciation, you please understand as amortization also. For tangible assets, we use the word depreciation. Intangible assets, we use the word amortization. Apart from that, they are same. Only terminology difference. Conceptually, they are not different. Okay. Hope you got the basics. Shall we go further? Okay, good. Now this standard don't apply to inventory, revenue from contract, deferred tax, employee benefits 105, 109, because these standards themselves take care of impairment. For example, we consider cost or NRV, whichever is less in Ind AS 2 inventories. Therefore, we don't have to impair it again here. Understood? That is why those things which standards independently take care of impairment themselves need not come to, or should not come to, Ind AS 36. So it will not come to these areas. Okay, now one thing is important. So when do you do impairment? There has to be an impairment for indicators. That is important. Please understand, there has to be an indicator of impairment. If there is no indicator of impairment, then impairment test need not be done. Impairment calculation also need not be done. Please remember, there are 3 steps. One, there has to be an indicator. Then you test for impairment. Then you compute impairment loss. Or yeah, first you check whether there is any indicator, something happened or not. If there are indicator, then you go for computation of impairment loss, then you account. So important word is there has to be an indicator. Indicator may be market value reduced, adverse effect taken place, coronavirus situation, lockdown effect, interest rates have increased, obsolescence, any of these things may be considered. But indicator is important. To give you an example, this may not be applicable for a CA student, but still in general. So you go home, you watch TV, you have food, you see mobile, no reaction from your parents. One day, what do? Suddenly you open your books and you start reading throughout the day. You don't watch TV, you don't use mobile phone, you will be continuously reading. For CA students, it may be normal. For other students, what will parents will feel? Why this fellow is started reading? What happened? They will come and speak to you. Are you okay? Anything wrong? Should we speak to anybody? Any problem in your relationship? Let us know. Because there is an indicator. Hope you are getting the point of impairment. Before something happens, there is some sort of direction. What is the direction? Indicator. So if there is any indicator, then you go for impairment test. But there are certain elements, even though there are no indicators, you should still test for impairment. Annual test is compulsory even without indicator. For whom? Intangible assets with indefinite useful life. We have discussed in the previous standard. Intangible assets not yet available for use, under development, we did previously, and goodwill acquired in a business combination. So these 3 cases, even though there is no impairment, you need to go for calculation of You need to go for test for impairment. But in all other cases, indicator must exist. Only when the indicator exists, you proceed further to go for impairment test. Okay, hope you got it fine till here. Any doubts on this point? How does an entity get to know future cash flow year on year? They have to do an estimation. You have to get a management estimation of what is their expectation. Cash flows management expectation is required. How they know? They will have the contract signed. They have the historical experience by doing the business. They know their profit margin. So using the machinery, how many outputs could be produced and sold? What is the profit margin? What is the cash flow from machinery? They will be able to identify. They should. Otherwise, why do they do the business? You told there is an indicator, but at the same time, impairment is sudden loss. So what to do if there is a loss of machine due to fire? A fire is an indicator. After fire happened, there is an indicator that machine would have been damaged. There is an indicator. I think you're not understanding the indicator correctly, my dear friend. Indication of impairment happened. Event of fire is an indication of impairment. Reduction in the market value is an indication of impairment. Fire is also indication of impairment. Corona effect lockdown is an indication of impairment. Your units are sold lesser and lesser day by day is an indication of impairment. There's no prior indicator like that. No. The fact that there is an indicator of impairment. Indicator may mean there is impairment. Okay, hope you got it. Shall we go further to the calculation of impairment? Shall we go further? Okay. Now, carrying amount of impairment loss means, we should calculate impairment losses compared with carrying amount. Carrying amount means book value, or you can also say WDV. And remember, it is at year end, and it is after current year depreciation. If you don't do current year depreciation, what will happen? The impairment loss will include element of depreciation also, which is not right. Even though it is an expense, reporting of depreciation is in normal course of business. Reporting of impairment loss means that something happened in the business. So the user should be aware of the differences. Therefore, to be able to give a correct picture, impairment should be separated from depreciation. So it should be after current year depreciation. Now, recoverable amount. How an asset can be recovered? Either by using the asset or by selling the asset. By using the asset, you get fair value and you get value in use, present value of future cash flows. Value in use nothing but present value of future cash flows from the asset. And by selling the asset means fair value less cost to sell. AS use the word net selling price. Ind AS use the word fair value less cost to sell. There is implication practically this differential terms, but for exam purpose you don't have to worry. So by using the asset, you will have value in use, present value of future cash flows. By selling the asset means you have fair value less cost to sell. Take whichever is higher. Because if you want to show impairment, something bad has happened, you have to be very clear something has happened. So something bad happened means it is recoverable amount. Under optimistic cases also your book value is exceeding. You cannot show, you cannot recover that amount. So recoverable amount is less, book value is more, then you have to bring down to book value, means there is a guarantee that something bad has happened. So you have to calculate impairment loss as difference between carrying amount after current year depreciation compared with recoverable amount, which is higher of value in use or the net selling price or fair value less cost to sell. And this impairment loss goes to P&L account. If you follow revaluation model, you adjust against revaluation reserves. WSCC is the discounting rate. It can be WSCC rate, it can be incremental borrowing rate, it can be when you calculate foreign currency cash flows, the adjusted discounting rate. That is left to the management to decide, appropriate for their business. When you purchase a machinery in your SFM, you would have done capital budgeting. What you would have done, those concepts you have to apply here. The required rate of return from that machine you have to apply. It may be business, it might be incremental borrowing rate, or it may be relevant for that segment. But the cash flow, what required rate of return you expect, that should be discounting rate. Okay, we'll do a problem which is recent RTP question. Yeah, recent RTP question. Let's read. PQR Limited is a company which has performed well in the past, but one of its major sub-assets, item of equipment, suffered a significant unexpected deterioration in the performance. Management expects to use machine for further 4 years after the 1st March 2006, but a reduced level. The equipment will be scrapped after 4 years. The financial accountant of PQR Limited has produced a set of cash flows projections of the equipment for the next 4 years for computing value in use, ranging from optimistic to pessimistic. CFO throughout the projects were too conservative and he intended to use the highest figures for each year. They are follows. The above cash flows should be assumed to occur on the last day of each financial year. The pre-tax discounting rate 9%. Machine could have been sold on 31st March 2006 for 6 lakh, and relevant selling expense in this regard could have been 96,000. The machine had been revalued previously on 31st March 2006 and amount of 36,000 was held in revaluation surplus on the asset. The carrying value of the asset was 6 lakh 60. The Indian government indicated that compensate the company for any loss, that you leave it. Calculate the impairment loss and revise depreciation. Also, such as impairment loss would set off how compensation from the government would be accounted for. Okay, now let me just again show it to you. Solution I'll give it to you later. Cash flows are there. You please discount it. Please forgive me for the columns. Discount it. Cash flows are given. Discounting factor given. Multiply. You get the present value. That present value is called as value in use. Compare it with the fair value, net selling price 6 lakh minus expenses. Now, whichever is higher becomes recoverable amount, which is 5 lakh 88, and carrying amount is 6 lakh 60,000. So impairment loss is 71,770 because there is revaluation surplus 71,770. Out of that, 36,000 is adjusted against revaluation reserve. Remaining amount will be transferred to P&L account. And going forward, from next year onwards, on 5 lakh 88,230 over a period of 4 years, depreciation will be provided. an answer regarding the government thing. Let me read once more. The Indian government has indicated that it may compensate the company. Okay, they said may compensate the company. Unless the government is clear, you never take it. Okay, because May has become June, June has become November, and so on. So unless the government comes with a clear guarantee scheme, the government may ignore that point. That should not be considered. This is a simple impairment loss calculation. If you have any doubts, please ask. Current year depreciation given, we should reduce 6,60,000. No, carrying value of the asset itself is on 31st March is 6,60,000. Carrying value at the end of the year means it is after depreciation only. No, why will you subtract again? Carrying value on 31st of March means after depreciation. Government ignored as neither contingent asset nor what is certain. We take it as remote and ignore. We ignore it because they may provide any benefit which we don't know, so we will ignore it completely. Even for the calculation of impairment for recoverable amounts, we don't consider it. If they have given carrying value at the beginning of the year, then I would have subtracted current year depreciation. That point you are right. Okay. One more point, reversal. Reversal of impairment can be done again when there is an indicator. When there is an indicator, reversal of impairment can be done. But how much impairment can be reversed, there is a limitation. The limitation is what would be the value of the asset if there was no impairment. Only to that extent you can reverse, not beyond that. Let me give an example for that. Suppose on 1/4/2017, cost of the asset was 1 lakh minus depreciation 10,000. Let's say equal life became 90,000, and you test for recoverable amount. Recoverable amount happens to be, let's say, 81,000. So 9,000 is the impairment loss. Now, next year, what will be having depreciation? You will provide on 91,000, 81,000. This 81,000 over a period of remaining 9 years. So that becomes 9,000. So carrying amount becomes 81 minus 9, 72,000. Credit cannot be taken for potential receipt, but only for actual receipt. Yes, you are right. 72,000. But here on these days, if you see recoverable amount is 73,000, yes, definitely 1,000 you can reverse. But if recoverable amount is, let's say, not 73,000 but 83,000, how much reverse you can do? For that, what you should do, calculate the value of the asset as if no impairment. No impairment means 1 lakh minus 10,000. Okay, this would be 90,000 only. And no impairment. So you would continue as 90,000 and you would have provide depreciation of 10,000. So it would have become 80,000. So 72,000 to 80,000. So only 8,000 can be allowed for reversal of impairment. 6,60,000 is post depreciation carrying value. Yes, you are right. At the end of the year. Now, if the carrying amount was 72,000 but the recoverable amount is now 83, if there was no impairment also, recoverable amount, the carrying amount would have been 80,000. That means the current carrying amount to the carrying amount if there was no impairment. I repeat, the existing carrying amount to the carrying amount if there was no impairment. Only to that extent reversal is allowed. You cannot call the balance amount as reversal of impairment. If you want to call reversal of impairment, no, that becomes revaluation reserve if you want to create an additional amount. That is what this point is all about. Reversal of impairment is allowed only to the extent of carrying amount if there was no impairment. I hope the impairment loss point is uh, uh, clear. As far as reversal is concerned, please confirm it. Then we go further. Yes, if they follow revaluation approach, they can create revaluation surplus, correct. But you cannot call impairment loss. You can call revaluation reserve, the excess amount. Okay, let's go further. I hope reversal is clear. Can you please confirm it? Is reversal of impairment is clear? There should be permanent increase in the value of the asset. Yes, you need to have an indicator. That's it. When only when there's a permanent reason you provide it for you provide for impairment. Only when there isn't permanent reason you reverse it also. So whatever the reasons applicable for providing impairment, same indicators can be used for reversal also. Okay, let's go further then. Okay, only one point on this part. Reversal of goodwill is reversal of impairment of goodwill is not allowed under Ind AS but allowed under AS. Reversal of impairment of goodwill is not allowed under Ind AS. The logic they think is when the goodwill is reduced, you provide for impairment. Now, if the goodwill has come back, that means you have worked towards it. Therefore, it amounts to internally generated goodwill. Therefore, that cannot be provided, as in general, internally generated goodwill cannot be recognized. So, Ind AS don't permit reversal of impairment of goodwill. Accounting standard permits it. Okay, let's go to this important point, which is CGU, corporate cash generating unit, then goodwill, then about corporate assets. How do we calculate impairment of these assets? Take an example of classroom. Take an example of classroom. In classroom, benches are there and chairs, of course. Chairs and benches, they generate cash flow. What about projector? What about faculty table or podium? They don't have independent cash flow. Therefore, therefore, what do you do? Benches and projector. When you compare, for benches, you can calculate cash flow, so you can do impairment tests. But for projector faculty table, you cannot do impairment test. When you cannot do impairment test individually, what do? You do the impairment on a group basis. So this benches, projector, faculty table together is called as group cash generating unit, and then impairment test is done. Please understand, benches will get the impairment test two times, one on an individual basis and then on as a part of CGU basis. But these projector faculty tables will be undergoing the impairment test only as a part of group. So CGU includes the assets which are already impaired, and CGU includes the assets which could not be allocated. They don't have independent cash flows. I hope this point is clear. If yes, please say yes. Some question for goodwill, how do we get future cash flows? I mean, how impairment testing done for goodwill? Goodwill also same thing from the business. If you want to sell in the market, what is your book value, how much you can sell, or there was a chapter on goodwill calculation also. You would have learnt in your CPT foundation. Super profits method, annuity method, capitalization method, average profits method. So many methods you can apply it regarding the goodwill calculation, goodwill impairment. Okay, I hope this CGU concept is very clear. Okay, now benches, projects, faculty table is one hand. Another hand, let's say you have two classroom, classroom 1, classroom 2, let's say IPCC final. There also benches will be there and projector will be there and faculty table will be there. This will be CGU 2. And then what happens? There is one accountant or receptionist in your premises, receptionist. Now, receptionist table cannot be given for CGU1 also, CGU2 also. So, all together, you call it as one more CGU, higher level CGU. I hope you are able to understand the concept of CGU. CGU is not just a group of assets. It is a group of assets at various levels. It is called as hierarchy of CGU. So here the benches, how many times it is undergoing impairment test? One as an individual, one as a CGU of this classroom, other is one as CGU of this premise. We can go further on one more CGU also, CGU about commerce level, CGU about science level. We can go to one more level, CGU of education, CGU of consumer, CGU of service. We can go to one more level, CGU of India, CGU of outside India. So the hierarchy is what you need to keep it in mind while going to the CGU. So you remember this, your individual asset, then you become one CGU, smaller CGU, and then you will be part of a bigger CGU or a larger CGU. Hope you are able to understand the concept of CGU clearly. Now, corporate assets will come only for larger CGU. Goodwill also will come for larger CGU. This is first point. Now, how do you calculate the impairment process? Impairment process. So, let's say there are three assets. Assets A, assets B, assets C. You will have carrying amount. There is one common assets. You can say corporate assets, common asset. First thing what do you do? This first choice what do you do? This common assets you allocate. You allocate. So you get the amount proportionately, some reasonable basis. You get the revised carrying amount. Revised carrying amount, you compare it with the recoverable amount individually, and then you got the impairment. And that impairment amount will be allocated to the asset on pro rata basis, proportionate basis. But if it is goodwill, okay, if it is goodwill allocated instead of common asset, if goodwill is allocated, then the impairment loss is first allocated to goodwill, because whenever something gets impaired, goodwill is what gets impaired first. So impairment on general assets on proportionate basis, but impairment on goodwill will get first allocation, remaining will be on proportionate basis. Now, there will be some common assets which cannot be allocated. When you cannot allocate, what do? You complete this impairment test and then you do the total carrying amount after this initial impairment test. Then you compare the recoverable amount of the full CGU. Then you allocate the impairment for the asset which could not be allocated. Okay, so what you need to keep it in mind, let me just summarize it. CGU means group of assets having the assets which cannot generate cash flow as well as the asset can generate cash flow. And keep it in mind, the asset which is generating cash flow would have been already tested for impairment before coming to this larger CGU impairment. Now, in CGU impairment, the steps to be applied are individual assets, then assets which are allocated, then you do the impairment test. If it is goodwill allocation, first adjust the impairment loss to the goodwill, then remaining to the other assets on proportionate basis. There are situations where some corporate assets, some common assets could not be allocated to the CGU or to the assets. In such case, you do the impairment test at a lower level, bottom test level, do the accumulated amount after impairment, if any. Then you get one total carrying amount, compare it with the recoverable amount of the CGU. That difference in the impairment is attributable to the common assets which could not be allocated. Okay, so in general, what you need to keep it in mind, common assets which can be allocated, proportionately divide. Common assets which could not be allocated, do the total, do CGU on a total basis. So these are the two terms we use, bottom up test, top down test. For the assets which can be allocated, we follow bottom up test because we allocate, and individually we will test for impairment. Where allocation cannot be done, we do it on total basis, that is called as top down tests. That is applicable for the common assets, corporate assets which could not be allocated. And goodwill allocation will always get the impairment first and then for others. And when you reversing it, goodwill impairment will not come, others can be reversed. I hope things are clear. We can go for the problem now. Before that, if you have any question, please ask. We have one problem which should give you clarity on the CGU which I just explained now. Top down test, bottom up test is there in Ind AS. They don't use the word in Ind AS, but concepts are there. Top down test, once more, can you touch? Top down test is applicable for assets which could not be allocated. When you cannot allocate to the individual assets, corporate assets like ERP, you test for impairment at a larger CGU level. That is, individual components would have been tested for impairment for the assets to the extent allocation could have been done. So once you test for impairment at an individual level, you aggregate it, you add the asset which could not be allocated, total CGU along with the new asset which could not be allocated, we compare it with the recoverable amount of the larger CGU. This larger CGU impairment test is called as top-down test. It's just a name. Don't worry about the name terminology. Understand the process. Can we go to the problem? Okay, let me go to the problem. XY Limited has three cash generating units. XYZ carrying amounts are given. XYZ also has corporate assets having remaining useful life of 20 years given below. AU, BU. The carrying amount of AU can be allocated. The carrying amount of BU cannot be allocated. Can you see the difference, my dear friends, here? AU can be allocated. BU cannot be allocated. So how do you test for impairment of AU? Individual assets, allocate it, then test impairment at an individual basis. But BU could not be allocated. So what do? Once this process of testing of AU is done, allocation is done, impairment is done, you get the total amount, then add this BU and then compare it with the recoverable amount. That will be the impairment applicable for BU. Hope you are getting the overall process right. Recoverable amount is given XYZ Limited, calculate the impairment loss for XYZ ignoring decimals. Okay, so first they said we can allocate AU. So let's allocate AU. XYZ total, allocate AU. They have given 800, 1000, 1200. And when you want to allocate, what is the reasonable basis? Reasonable basis, we go with the carrying amount. But when the useful life is there, we should consider that also. So we'll do a product, we'll do a ratio. Then we'll do a percentage. So useful life 20, 10 and 20 multiply for the purpose of proper allocation, reasonable allocation. 800 into 20, 1000 into 10, 1200 into 20, total comes to 50,000. Compute the percentage now. Weights in terms of percentage, you can do proportionate also. 16,000 out of total 50,000, we get 32%. Then similarly this 20%, 48%, total 100%. So this is the basis on which the carrying amount of AU can be allocated. That will come to, so XYZ total you have 800,000, 1,200. You can allocate this 800 amount, this percentage 32%, 20%, 48%, which will come to 256, 160 and 384. This is the revised carrying amount. So carrying amount, allocation, revised carrying amount. Compare it with the recoverable amount. Recoverable amount is given 1000, 1200, 1400. So you compute which is the impairment. In the first case, revised carrying amount 1056, impairment is 56. Second case, recoverable amount is more, so no impairment. Third case, recoverable amount is less, impairment of 184. Now, up to this stage, tell me if you have any doubts. Simple process, XYZ, allocation, revised carrying amount, compare it with recoverable amount, difference becomes impairment loss. Difference becomes impairment loss. Why don't have impairment? Because Y carrying amount is less than the recoverable amount. No impairment there. Okay, hope you have done till here. Now, this impairment loss is belonging to whom? This 56 is out of 1056. What is 1056 comprised of? The carrying amount of X 800 as well as the allocation of this AU 256. Both of them are the part of 1056. So 56 also should be allocated among the X units assets and AU proportionately. How much? 56 by 256 by 1056 and 800 by 1056. In that proportion you have to allocate. You will get 42 and 14, 14 and 42. And if this was not a AU asset, if this was a goodwill, what you would have done? This 56 would have been first allocated to goodwill, then remaining would have gone to X units assets. Because this is carrying amount of the AU corporate assets, proportionate pro rata basis is calculated. Is it reversal of earlier impairment? No, we are not reversing. We are providing impairment. We have calculated impairment. But impairment against whom? We need to allocate, right? We need to divide. Who has to take the impairment loss? From which asset we have to reduce for passing entries? We are just allocating. We are not reversing it. So we get 42 for other assets, 14 for AU. Why? Anyway, nothing is there. For Z also, divide proportionately. That is proportionate amount 384 divided by 1484. Then 800 divided by 1200 divided by 1484. That will give you 45. This is 14 and 42. And this is 45 and 139. Okay, now this is what you can say a bottom up test, because we are allocating it and then doing the calculation. Anyway, terminology you forget about it, but did you get the concept right? For the corporate assets which can be allocated in a CGU, corporate assets which can be allocated on a CGU, this is the process of calculation. Can you please confirm it? Now we compare carrying amount of post impairment for XYZ, AU and BU, and then compare recoverable amount of XYZ. Correct. Goodwill, can you explain? Suppose the same question, if this was not AU, if this was goodwill calculation, assume if it was goodwill calculation, then entire 56 would have been allocated to this. So this 256 will become 200 later. Because when impairment happens, goodwill will get impairment first. Only when this crosses 256, suppose this becomes 257 impairment, then 256 goes to goodwill, 1 goes to the other assets. Hope you're able to get that point, my dear friends. If it is goodwill, first goodwill will be allocated, remaining only go to other assets. Here we did proportionately. That proportionate thing don't come in goodwill. Goodwill will get the first hit, then others. Okay, let's go further. Now step 2 is for larger CGU, because AU we have done the allocation and with the impairment allocation is also done, but BU, which could not be allocated, requires impairment test now. So for that purpose, so what was the carrying amount? 800, 1000, 1200, 800, 400, and in the first step we did the impairment, that is 82 we did for X, nothing for Y, 139 for Z, and that proportionately we did 14 related to X, 45 related to Z in the allocated amount we had done in the previous step. Those amounts you subtract from AU. BU we did not know the amount. Revised amount we get. Remember, revised amount, revised carrying amount after impairment in the test 1 at level 1. You get total 3960. Recoverable amount is 3900, which is now you get impairment as entity as a whole 60, which will be allocated to BU, because X is already impairment test is done, Y is impairment anyway not possible, Z impairment test is already done. Therefore, this amount will now be allocated to BU. If there is one more asset is there, CU, then this 60 would have been allocated against this 400 and this proportionately. Anyway, this is how you do the impairment of a corporate asset, common assets, which can be allocated at the first step and which cannot be allocated at a larger level. Okay, this is about Ind AS 36. Next one is Ind AS 40, investment property. Please let me know if you have any question on this standard, else we'll go to next standard. I hope you got some confidence in the impairment now. I think many of you would have been worried about being impaired by following impairment, at least with classes. Hope that impairment got reversed now. Impairment loss can be allocated to PPE, intangibles, as other assets are out of scope. Yes, it's only about those two, only to PPE and only to intangibles, because all other assets are out of scope. Yes. So getting confident now, good. But that is one point I would like to recommend you, friends. How much ever theory you read, solving problems only gives you the confidence, because that is where numbers come into picture and that is where real test is done. So whenever you want a clarity, go for solving problems, you get the clarity. Then read the theory once more. Theory will going to stay in your mind. Okay, let's go for investment property in AS 40. This is only for new syllabus. This particular standard is not there for old syllabus. Now, investment property specifically is a particular case which is for land and building or part of the building, and objective is to earn rentals, capital appreciation or undetermined. So when you are using it for real estate purpose, if it is real estate company, that becomes AS2 in AS2. If you're using it for your own business like administrative purpose, for manufacturing purpose, then they will become in AS16, plant property equipment. When you're holding it like your investment, just like you have investment in shares where you're getting profit, a dividend, or you're planning to sell and make profit, when you invest in property, that is called as investment property, only relevant for land and building. Okay. Okay, recognition, same conditions apply. Replacement, subsequent replacement, same conditions apply as in day 16. Cash price, startup cost, cash price is capitalized, recoverable duties and tax are not capitalized. Held under lease, lower of financial, that is the financial lease will apply. Exchange of assets will apply similarly. This is important. Subsequent measurement, only cost model, whereas IFRS allows cost model as well as revaluation model. So this is one of the carve outs, I would say. This is one of the carve outs. Okay, so these are the important points. That's all the important point, nothing more, nothing great about investment property there. We will do one problem. Only one problem is there in the material. We'll do one problem. Any questions on the investment property? Yeah, fair value will be disclosed. Yes, fair value will be disclosed but not recognized. It is using the cost model after depreciation, not at cost. Yes, it is a cost model, not cost. Depreciation we provide. Anyway, so solving this problem should give you more clarity. Let us do. Star Limited is a multinational company that owns three properties. All the three properties were purchased on 1st April. The details are given below. Property 1, property 2, property 3. Factory lettered building, subsequent measurement, cost model, revaluation model, evaluation model. Property 1 and 2 are occupied by Star Limited, while 3 is let out for non-related party at market rent. The management presents all three properties in the balance sheet as property, plant and equipment. The company does not depreciate any of the properties on the basis that the fair value or exceeding their carrying amount, and recognize the difference between purchase price, fair value, statement of profit and loss. Evaluate whether the accounting policies adopted by Stars Limited in relation to these properties in accordance with relevant Indian accounting standard. If not, advise correct treatment with gains. ROU asset also can be investment property, or is it only for owned assets? ROU asset also can be investment property. Sublease. If you are subleasing the property on operating lease basis, that will also come under investment property, provided it is a property, not all ROU subleases. Okay, so the point is they want to follow let out building revaluation model. That cannot be done because we follow only cost model. Property 2 revaluation model, property 1 cost model, that is again not possible because as per Ind AS 16, when the nature of the assets are same, the type of models also should be same. Now, property 3, we have to follow cost model. Can you please tell me in the answer section, for property 1, should we follow cost model or revaluation model? Which one should we follow? For factory, can you tell me, should we follow cost model or revaluation model? For factory, which one should we follow? Cost model or revaluation model? Okay. Yes, Gautam, I have asked the MCQ question yesterday also. You can either follow cost model for both, or you can follow revaluation model for both, as long as you're able to justify it. But you can't have two distinct model. That is the important point. So your answer in the exam expectation also is going to be on this basis. The points I've explained already. So you have to give scenario based answer. Case A. What is that case A? If it is under cost model, cost is 30, depreciation 3, carrying amount 27,000. Then 20,000, depreciation is 2,000, carrying amount becomes 18,000. Investment property, that anyway you can only follow cost model, but the fair value will be disclosed in the brackets. That is for cost model approach. Then case B, we will show it to you. Okay, this is case A. Now case B, if you follow revaluation model, that is what revaluation model? Revalued amount 32, revalued amount 22, and you will have to show investment property at cost model only. That there is no choice. One more point, you will have revaluation reserve, OCI, other equity. How much? 27,000 to 32,000. What is the increase? 5,000 is revaluation reserve. What about the other one? 18,000 to 22,000, that is 4,000 revaluation reserve. So in the examination, you have to present case A also, case B also. Mark this as important question for examination. Okay, any doubts till here before we go to the next standard? It's a very simple standard in days 40. How to remember this? Okay, in days 40, how to remember this? It's a property. Property means, how do you look like site, right? This is the property. How does it look like? How many sites are there? 4 sites. This looks like 0 also. So 0. Investment property 40. What happens to on disposal of investment property? Just like any other PP you sell, profit will go to P&L account. If you yeah, profit will go to P&L account. Correct. No revaluation model. Profit will go to P&L account. Subsequent reclassification, no change in the subsequent reclassification is merely due to application of new standard due to purpose of use, and neither change in accounting policy nor change in accounting estimate. Correct. Whatever the change from the date of transfer, it will become, let's say, owner occupied property. If the use is different, after that you go for the whatever PP, that classification will come. There's no special treatment, but the cost model, whatever the cost, becomes the carrying amount for new use. That's all. Any other questions? Okay. Now coming to next standard, Ind AS 105, non-current asset held for sale and discontinued operation. Under accounting standard, this is covered under two standard, AS 10 as well as AS 24. So apart from that, this discussion what we are having now is applicable for old syllabus as well as new syllabus. Non-current assets held for sale. So in Ind AS 16, once it is available for sale, it will be moved out of this and it will come to Ind AS 105. We have discussed this during PPE also. Now once it comes to this standard, Ind AS 105 applies. PPE given on rent by parent to subsidiary in PPE in separate fund statement, investment property. Correct. PPE, yes, you are right. Your answer is right. Actually, your answer is reverse. In separate financial statements, it is investment property. In consolidated fund statements, it is PP. Your answer is reverse. Okay, let's go further on this. Now, for you to classify it as available for sale, important point is it is available for sale in the immediate condition. Present condition, immediate condition. That is, it should be available for sale immediately. If you are having some doubt, I may sell, I may not sell, those kind of things don't come here. It is available for sale immediately. Just for giving an comparison, I give an example. Don't take me personally. Let's say your friend is following through some breakup. So you keep asking him, are you having breakup, are you having breakup? He will tell you, I'm thinking. That is not non-current asset held for sale. One day he will tell you, I have a breakup. So what you can tell? You have a breakup? Sure, I can try now. You want to reach that stage where one person is completely given up. This asset is held for sale, no doubt about it. It is for available for sale in the present condition itself. Then it becomes non-current asset held for sale. And once it comes non-current asset for sale, no depreciation, and you are going to apply the impairment principles. Not impairment, but impairment principles. What is impairment principle? By comparing the value of the asset carrying amount and compare it with the recoverable amount. The recoverable amount cannot be value in use because you are not intending to use. It can only be fair value less cost to sell. So once the asset comes to Ind AS 105, depreciation stops, impairment principles are continued. That is regarding non-current assets held for sale. Important point is it is available for sale in immediate condition. Second, discontinued operations. Discontinued operations means your significant business segment, consumer segment, software division, a segment is sold, discontinued. AS24 uses the word discontinuing, whereas Ind AS is the word discontinued. It is closed, finished, transferred, sold, over. Things are over. Then what you should do? In your P&L account, sales should not include these discontinued operations. It should only from continuing operations. All expenses should only be continuing operations. Then what will happen to the profit or loss on these discontinued operations? Sales will be there, expense will be there, interest cost, employee benefit expense, all these things come together and one line will come: profit or loss, net profit or loss from discontinued operations. And the breakup of this profit or loss, sales amount and then expense amount should be given in the notes to accounts. That is, and for Ind AS, for AS24, only difference is there they follow discontinuing operation, not discontinued. Discontinuing operation mechanism is very similar. They are also disclosed separately. We'll do one problem in this context. Yeah, we'll do one problem only in this context. If you have any doubt, you can get it clarified. Ind AS 105. Okay, I hope no questions on this. Can we do a problem applicable for old syllabus also? Okay. Impairment also stops, right? Anyway, it's fair value less cost to sell. Yes, impairment principle I told. Impairment don't apply. Once it comes to Ind AS 105, no Ind AS 16, no Ind AS 38 or Ind AS 36. Okay, let's go further. Read this problem. An item of plant equipment is measured on the cost basis, should be measured in accordance with Ind AS 16. It was stated in the following amounts: cost, depreciation, net book value, Net assets are depreciated 10%. During the year July 2002, ABC Limited decides to sell the asset, and on 1st of August, it meets the condition to be classified as held for sale, having fair value of 5,40,000 and 40,000 rupees cost to sell analyze. So carrying amount 6 lakh. This is the carrying amount net book value. Then depreciation only for 7 months. This is the December ending company. So for 7 months up to July, we provide depreciation 1,20,000 into 7 by 12, that is 5,30,000. This should be compared with the principles of impairment, no depreciation, which means what? 5,40,000 is the fair value, less cost to sell 5 lakh. So difference 30,000 will be transferred to P&L account. That's all. Very simple one, simple question. Still can come in exam. Okay, let's move further. In this 105, the presentation part I told you already. Okay, let's go to Ind AS 41, agriculture. This is again only for new syllabus. Ind AS 41 agriculture is not there for old syllabus, only for new syllabus we will address it now. Now, Ind AS 41 agriculture. Again, how to remember? This is the first thing done by human species after getting a property. So you got a land, that is Ind AS 40, investment property. After doing, which is the first business you started, you start cultivating it. So the next activity you did is agriculture. So Ind AS 41, the logical sequence after purchasing a property done by human species first is agriculture. So investment property is Ind AS 40, agriculture is investment, agriculture is Ind AS 41. Think after property purchase. Okay, what does agricultural activity means? Agricultural activity means biological transformation, growth, degeneration, production, qualitative or quantitative changes. That is basically, you know the meaning of agriculture. You can grow crops, you can produce the fruits using the trees, or you can have animal husbandry also, poultry farming, dairy farming. All these are called as the agricultural activities for sale or conversion into agricultural produce or into biological assets. It applies to all agricultural activities. What it does not apply to is bearer plants. Where does bearer plants are covered? Under Ind AS 16. Okay, just to give you a simple example on processing. If you take a orange juice, Tetra Pak, how the process happens overall. From the orange trees, the fruits are plucked, it's processed, and the bottles are made. Now, the process of growing the orange trees is bearer plant because they are bearers of fruits. So, Ind AS 16 applies. But these fruits are agricultural produce. The process of plucking the fruits is agricultural produce. But once they are converted into the bottles, they become Ind AS 2 as inventory. They no longer will become the concept of the fruit part. That is, they will not become agricultural produce. Now, recognition, control, legal ownership, right to sell, same concept, probable economic benefits, reliable measurement, not of cost, reliable measurement of fair value. This is important. It is, if purchased, it is at cost, it's fine. But if developed, it is recognized on fair value basis, not only now, even subsequent measurement, fair value less cost to sell. Why that happens? Let me give an example. Suppose you had 100 cows at the beginning of the year. You purchased 10. cows. You sold 10 cows. Year end, there are 102 cows. Can you tell me what is the cost of those 2 cows? Which method of cost you calculate? FIFO method? You calculate weighted average cost method? You calculate standard cost method? How can you calculate the value of those 2 cows? They are like bonus shares. You can't calculate them. That's why standard says let's not go for cost basis. If it is developed, the biological assets, let's go for fair value basis. Can orange fruit be inventory? Business is a fruit store. Yeah, you are not doing agricultural activity. No, you are purchasing the fruits and you're selling it. You're a trader. You're not an agricultural activist. Your agricultural activity don't apply to you. Only if you're a farmer, for you, those fruits are in days 41 agriculture valued on fair value basis. But for the vendor, he is a trader. For him, agricultural activity don't apply. He buys and sells. He is not involved in any agricultural activities. Okay, this is the main concept of biological assets valued on fair value basis. Okay, one more important point. You have to report physical changes as well as price change. For example, you purchase one 3-year cow. The value of that was 5,000. Okay, this is at the beginning of the year. At the year end, now this 3-year cow become 4-year cow, and this price, let's say it is 5,500, and the 3-year cow, if you purchase at the year end, it would have been 5,100. So 5,000 to 5,100 is called as price change. Even if nothing happened, the value would have been increased from 5,500 to 100 to 5,500. This 400 is called as the volume change, or they say physical change. Like the way you would have done in your costing, right? Uh, in case of sales variance or variance analysis, price variance, volume variance, quantity variance, this is the similar aspect. The price change, price variance, quantity variance, the physical change. So that needs to be reported in the notes to accounts. Basically, biological assets and produce are at fair value less cost to sell. Yes, biological assets are recognized on fair value less cost to sell basis, because cost is not reliably measured. Cost is not reliably measurable. Therefore, we don't go for cost, we go for fair value. That is why the standard is uh, that's why this standard is introduced to bring into the effect of fair value. Agricultural activity is not by human control, so we can't really compute the cost of it. Like the example I gave you, cows. How do you calculate the cost of those 2 cows? Not possible to calculate. So we go for fair value approach. Okay. This also at fair value approach, and difference, yeah, will be transferred to P&L account. And if process further, then they become in days 2. That point I've explained it. No problems as such, only for discussing purpose. Okay. Now employee benefits, AS 15 old syllabus as well as in AS 9 new syllabus. Old syllabus people also, new syllabus people also. For both of you, this standard is definitely important. Any doubt up to this stage, or else can we go to employee benefits? When we are moving from standard, say from 41 to 2, then carrying value of 41 becomes the cost for inventory. Correct. Fair value on the date of conversion becomes the cost for inventory. Can we move further? Can you please confirm? Okay. Now, AS15 in days 19. How to remember in days 19? Usually, your PU or 12th, you will be done by 18 years. Things you can start working after becoming 19 years. So, after 19, you can become employment. Even for CA, after becoming 19, you can join, you can start doing CA. So, you are ready to become an employee. Anyway, so in days 19 is employee benefits. Objective and all, don't worry. Okay, employee benefits. Okay, there are broadly four varieties. Short term employee benefits. Short term, like wages, salaries, bonus payable. It may be payable within 12 months. If it is payable after 12 months, that becomes long term employee benefits. Post employment benefits means payable after employment. Termination benefits also payable after employment, but that was not expected. That was unscheduled. That is employee's decision to accept. Now, in the short-term benefits, there are two expense. One is called as accumulating method, other is called as non-accumulating, compensated absence. I'll explain this concept. Okay. Let me explain this concept. Suppose an employee works for, let's say, 300. Let's say an employee normal working days is 300, and he is given a leave entitlement, sick leave, casual leave, whatever it is, leave entitlement for 30 days. Okay, so now an employee works for, let's say he takes actual leave of 10 days. Okay, and his salary is, let's say, 3 lakh rupees. Now this 3 lakh rupees, can you tell me whether for how many days this is related to? Is this related to 300 days? Is this related to 270 days? Or is this related to, he has taken only 10 days leave, so 20 days he has not taken, so that means 280 days. Can you tell me in this example, employee, the amount payable 3 lakh is relevant for 300 days work, 280 days work, or 270 days work? The 3 lakh amount paid is for how many days work? Three hundred, 270. He worked for 280 days also, keep it in mind. Okay. So the answer is 270 days. 270 days. But he worked for 280 days. So he worked 10-day extra. That act okay, not actually 10 days. So 290, I'm sorry, this should be 290, no? Sorry, 290. Actually, only 10 days. He worked for 20 days extra. The extra what he worked, in other words, leave unutilized. Leave unutilized. Where employer got the benefit, but employee was not paid. Are you getting this point? For the leave unutilized, that means the employee worked. In that case, the employer got the benefit of the work, but he did not make the payment to the employee. When will the payment be made? Later years, leave encashment accumulating. So whenever the employee going to utilize, then the employer will make the payment, which is future, but employer got the benefit now itself. So for those leave which will be paid later, should be accounted this year itself. But this entitlement transfer, the terms of conditions may put some restriction that you cannot carry over 20 leaves like that. You can only carry over 5 leaves. So what should happen to the summary of this? To the extent of leave unutilized by the employee, to the extent it can be carried forward and utilized, expense liability should be recognized. Two conditions: leave unutilized this year and entitled to use in the next year. Repeat: leave unutilized in this year and entitled to be used in the next year. To that extent, this year expense should be recognized. If it is not able to carry forward, expense should not be recognized. In that context, let us do one simple problem. Sundaram Private Limited has headcount of 100 employees in 2010-11. As per the employee policy, employees are entitled to 30 annual leaves, out of which only 10 may be carried forward. Please observe, they cannot carry forward more than 10. Restriction, it has to be less than 10 or 10 or less than 10. 10 sick leave, out of which 2 may be carried forward. Oh, here restriction. To fall sick also restriction. Falling sick, there is not restriction. You want to postpone your method of falling sick, that has a restriction. Because some people we take sick leave whenever we decide to fall sick. You are article students, I need not tell you. On 31st March 2011, the average unused entitlement is 5 for privileged leave and 1 for sick leave. On an average, it is found that the number of such employees who would be claiming, both are important, unused and who would be claiming annual leaves would be 30, and 10 employees would claim sick leaves. Compute the liability to be recognized as sick pay and privileged leave by the entity. I can give the answer in a very simple manner, but I would like to give it in the form of a columnar to get a clear idea. Privileged leave 30 days, and how many were actually unutilized, unused? Only 5. And how many employees? 100 employees, so 500 days. We'll divide this into two categories. How many employees are claiming and how many employees are not claiming? 5 employees are 30 employees are only claiming. 30 employees are claiming. How many are claim? How much claiming? Entire 5. Sometimes they might not claim entire 5. It might be 3 or 2 also. In such case, only that much should come. And that utilized is 150. And in case something they don't utilize, I repeat, 30 employees are utilizing 5 days completely. 30 employees are utilizing 5 days completely. Who knows? Some employee may not use that 5 days. Some employee may use only 3 days. In such case, that 3 will come here as utilized and lapsed will come as balance 2. And balance employees, that is out of 100, 30 year, balance 70, they are anyway not claiming, that will lapse. Similarly for sick leave, 10 days is available, but unused is only 1 day. So remaining 9 days you have fallen sick or decided to fall sick. 100 days on 100 employees. And how many employees are using? Employees using are only 10 employees. That is 10, and they're utilized, unutilized will lapse, and not claiming means also it will lapse. So ultimately, you should recognize the expense on 150 days and recognize the expense on 10 days. This is the broad overview of compensated absence. Hope you got this point clear. If you have any doubt, please ask. Else, we'll go to one important area on the long-term benefits is over. That is post-employment benefits. Two methods are there. Very important. We will do one question also. If you have any doubt till here, please ask. Can we go to post-employment benefits? Okay, let's go to the important point here. Post-employment benefits, defined contribution plan, defined benefit plan. Try to get the basics of these two, then we go for the accounting part of it. This is the difference between an Indian parent mindset versus a Western developed countries mindset. When you talk about Indian parents, they save money, they work not only for their growth, they work for their children's education, children's marriage, their children, their children, their children. When you look about our so many politicians, the wealth they accumulate generations together, that is the nature of defined benefit plan, where they take the responsibility of saving money and making the payment to their children's, meaning their employees. Defined contribution plan means Westerners. I will make sure that you are grown to this extent. Until you become an adult, I will support you. Beyond that, you are independent, I am independent, you are not your own. That is defined contribution plan in the context of application of the standard. So what happens in defined contribution like PF? Employer contributes, his responsibility is over, he takes no further responsibility, no further liability. But defined benefit plan like gratuity, the employer assumes responsibility. So in employer assumes responsibility means there is two things to be created. One, he has to create an expense over a period of time because he get the benefit. He can't create the liability on the payment, that becomes cash basis accounting. So over a period of time, as and when the employee works, the employer should recognize expense. He has to build up the expense liability based on estimations. But when the employee leaves, you should have the money ready also. So he has to save the money. That saving money is called as planned assets. Saving money is called as planned assets. So these are the two parts about which you need to understand: planned liability and planned assets. Now current service cost means, suppose employer says If you work for 10 years, then you will get rupees 1000. But for how long? For 10 years. So what is attributable to every years of service? 1000 by 10, that is 100 rupees. That is current service cost. But we don't recognize 100 rupees also. This is attributable to current year. But when it is paid after 10 year, so we should do a discounting factor for this. So current service cost is expense attributable to current year but discounted by considering the payment period. So attributable to current period but present value of cash flows is called as current service cost. Now as and when the time progress on this 100 rupees, next one more 100 interest gets accumulated, that's called as interest cost. Then actuarial gain or loss, I'll come to it. What is actual gain or loss? That is, these things have some assumptions. What is assumptions? Gratuity is payable based on the last drawn salary of the employee. Can you tell, when an employee comes to you for interview, can you ask him what is your last drawn salary expectation? He will not join your company only. So it requires estimation, it requires assumption. Those assumptions are called as actuarial assumptions, and they can change subsequently. When those changes, that should also be accounted, and this is also called as remeasurement changes, loss or gain, called as actuarial gain. Then past service cost. Past service cost means the expense recognized in the current year but relevant for previous years. When that will happen? Same example, rupees 10,000 for 10 years. You recognize current service cost of 1,000 per annum on present value basis. But after 3 years, he revised, no, 10,000 is not good, we should make it as 12,000. So what will happen now? 12,000 by 10 years means 1,200. Going forward, 1,200 is fine. But what about the 2 year already over? The 200 extra should be recognized. That is called as past service cost. Expense relevant for the service already done, but recognized in the current year due to changes in the agreement terms. That is past service cost. Effect of curtailment or settlement means, if you provide a liability of, let's say, 400, but employee leaves earlier than expected and you have to make a payment of 380 rupees. Your liability is 400 but payment is 380, so 20 rupee becomes your gain. That is effect of curtailment, and in the balance sheet you show present value of defined benefit obligation. Now planned assets, I told you amount has to be saved. Assets, remember, this will not go to P&L. Planned asset is like sinking fund. You keep saving your money every year so that when employee leaves, you will not say, sorry, I did not know, I have not saved money. You have a responsibility to save money so that when employee comes, you should be able to settle his amount without any delay. And on the planned assets, you get one expected return, but your actual return may be different. That is called as actuarial gain. Again, this also called as remeasurement loss. And fair value of planned assets, it should be valued on fair value basis. And this actuarial gain, remeasurement loss, as per AS 15 goes to P&L, but as per Ind AS, it goes to OCI. As per Ind AS, it goes to OCI. Okay, anyway, this is the things required. We'll do one problem based on that. This is again, I believe, yeah, RTP question as well as MTP question, important one. So if you have any doubts, you can ask. Otherwise, we go to problem. Can you confirm it? Is it fine? Okay, let's go for this problem. On April 1st, the fair value of assets of X Limited's defined benefit plan were 20 lakh 40,000 and present value of defined obligation is 21 lakh 25,000. On 31st March 2002, the plan received contribution from XYZ amounting to rupees 4 lakh 25,000 and paid out the benefits of 2 lakh 55,000. The current service cost for the financial year ending 31st March 2002 is 5 lakh 10. Interest rate is 5%. To be applied to the planned assets and obligations. The fair value of the planned assets on March 2002 was 23 lakh 80. Present value of defined benefit plan was 27 lakh 20. Provide reconciliation from the opening balance to the closing balance of asset and liability obligation. Also show how much amount should be recognized in the statement of profit and loss, other comprehensive income, and in balance sheet. Okay, let me just explain yeah, I think solution is there. Let me just explain, it will be faster. Just observe. We will do asset as well as liability in a columnar format. Now opening balance 20 lakh 40,000 given, 21 lakh 25,000 given. Interest you charge at 5%, 5% on 20 lakh 40,000 and 5% on 21 lakh 25,000. Current service cost, that is an expense that goes to liability, that will not come in the planned assets. Contribution received, it is a savings that will only go to planned assets. Benefits paid, when you make a payment, that will go to liability, will reduce, asset also will reduce. So both places you subtract. Then return on gain, balancing figure, actuarial loss, balancing figure. Anyway, this is the remeasurement loss. This amount is the balancing figure, this amount is balancing figure. These are remeasurement losses, these are remeasurement losses. Now what and all goes to P&L account? This current service cost goes to P&L, and the net interest amount means this 1,02,000 and 1,06,250, the difference is there, that will also goes to P&L account. And what will go to OCI, other comprehensive income, under AS 15, this also will be P&L account only. Remember, under AS 15, this also will be P&L account. Loss on defined benefit obligation, which is this number 2,33,000 is a loss, and this 68,000 is a gain. And in the balance sheet, this will be on a net basis. 23,80,000 is asset, 27,20,000 is liability. Net liability will be shown in balance sheet. A simple problem, tricky question. Go through the problem for 2 minutes and go through the solution. Let me know if you have any doubt. Any questions up to this stage? Any question on this problem? Okay, I think we can proceed further to next standard. A simple problem, but it came in RTP also. MTP also. So very important from exam point of view. Okay, good. Let's go further. Ind AS 37, provisions, contingent liabilities, and contingent asset. Now, first of all, how to remember this standard? Very simple. Can you tell me which section in the Income Tax Act which allows general expense deduction, general liability, general expense in Income Tax Act? Can you tell me which expense, general expenses are allowed, general reduction in Income Tax Act? Section 37. This is what we are doing in AS 37, provisions, contingent liabilities, and contingent assets. The general thing, general liability, general provision, general expense comes in Ind AS 37. Okay, so what are things to be understood here? Here we need the concept of what do you mean by the word a liability, and what do you mean by the word a provision, and what do you mean by the word contingent liability. Maybe one more also we can have, contingent asset. Now liability means it's a present obligation as a result of past event having future economic benefit. Provision also means present obligation, but amount is uncertain, so it requires with an estimate. Contingent liability means possible obligation, or maybe a present obligation without estimate. There is a present obligation, but you are not able to make an estimation, then also it is contingent liability. But normal definition of CA students, what do you mean by contingent liability means which may or may not happen, or they say my result may or November happen. That used to be applied to results and CA students degrees. Now it is applicable to CA exam itself. It may became, now May became July, now it may become November, we don't know. Anyway, these are called as contingent, where it is possible obligation, where it is uncertain event. Possible obligation, and depending on uncertain event. Contingent asset also, it is a possible right, possible benefit, not a existing benefit. Now present liabilities are provided in the books of accounts. They are provided for. Provisions are also provided for. Contingent liability disclosed, and if remote chances, if the chances of liabilities are remote, then disclosure also not required, no disclosure also. Contingent assets is disclosed. Again, contingent liability also disclosed, contingent asset also disclosed as per Ind AS. But as per AS 29, contingent liability disclosed, but contingent asset is not disclosed. When will you recognize it? Recognized when it is virtually certain. When it is virtually certain, it is recognized both under AS also, under Ind AS also. This is the broad overview of it. Let us do a quick problem based on this. Okay, one point I should tell. What is this? Executory contracts. Okay, executory is fine. We have to understand the onerous contract. The executory is fine. I'll explain. But onerous contract is what you need to understand. Yeah, onerous contract. Onerous contract means they are unavoidable. Cost of meeting obligations exceeds benefits. Accounting, you have to recognize it as liability. And before providing any onerous contract, you can always go for impairment under Ind AS 36. Anyway, let me give an example. You have committed or you have entered into a contract agreement where to sell on 15th of April 2020 at certain products. If you fail, there is a penalty of 50,000 rupees. So you have an agreement to be sold. You have an agreement to be sold. Just give me 1 second. Okay. So you have an agreement to be sold. If you don't sell it, you have to pay a penalty of 50,000 rupees. Now, as on 31st of March 2020, you have not produced the goods. And if you and this selling price is, let's say, 5 lakh rupees. And now, as on this date, the cost of this product has become 5 lakh 20,000 rupees. Now, you have two choices. Either you sell the goods. If you sell the goods, what is going to be your loss? Not loss now. Loss will happen. Loss of 20,000. If you don't supply the goods, you have to pay penalty of 50,000. Now, among these two, how much is unavoidable? Unavoidable cost. Unavoidable cost is 20,000. You know that loss will be incurred on prudence premises. Even though loss will be incurred in the future years, you have to recognize in the current year itself. That is called as onerous contract. Unavoidable cost of meeting the contract obligations. One more example, only example, don't take me personally. You were desperate to enter into one relationship. So you asked for one person. I don't want to call boy or girl, one person I will say. Other person told one condition, okay, I will be in relationship, but give it to me in writing that you pay my mobile expenses, all the staying expenses, traveling expenses, mall expenses, every expenses, phone expenses for next 3 years. You were desperate, you signed it in the agreement. After 2 months, the person is not in the relationship with you now. Now, what is your situation? You are not receiving any benefits. At the same time, you have entered into an obligation to make a payment. The contract is there, you have to make a payment, but benefit is not there. Payment may happen in future, but benefit will not come. You know it now itself. So, whatever expected cash flow that will happen because of that agreement, you have to make a provision now. That relationship is called as onerous contract. Anyway, I just want to give an example, nothing beyond that. Let's go to one problem to understand it. Okay, any question before we go to one simple example? After the example, we'll conclude for the day. Don't worry. One question is coming. Remeasurement to OCI is with or without recycling? It is without recycling. Dear friend, in the first day, I have given you the list in a tabular format, which are with recycling and which are without recycling. I have given you the list, exhaustive list. Please refer it for a quick reference a day before exam. Okay, let's go to this problem. A company manufacturing and supplying the process control equipment is entitled to duty drawback if it exceeds turnover above specified limit. To claim the duty drawback, the company needs to file an application within 15 days of the meeting specified turnover. If the application is not filed in stipulated time, the department has discretionary power of giving the duty drawback credit. For the year 2001-2, the company has exceeded the specified limit of turnover by the end of reporting period. That they have done. However, duty drawback can be claimed on filing of application within the stipulated time, within 15 days, or on the discretion if they allow it, if the application is late. The application for the duty drawback is filed on April 20th. That is after 15 days, where it's after stipulated of 15 days of meeting the turnover condition. Duty drawback has been created by the department on June 28th. The financial statements have been approved by the board of directors of the company on July 26th. What would be the treatment of duty drawback rate as per the given information? Okay, so now the question here is, in simple words, you can say, is it an adjusting event or a non-adjusting event? And this duty drawback, should it become contingent assets or actual assets? This is a I think recent RTP question, as well as this is a problem related to Ind AS 10, event occurring after balance sheet date, as well as relevant for Ind AS 37. It is combination of both. So please read it carefully and think. Please read, important from exam point of view. Important from exam point of view. Okay, it's adjusting and contingent asset. Okay, now I'll read the institute solution and I'll try to explain that as well. Let's go for institute solution. In the instant case, the condition of exceeding the specified turnover was met at the end of reporting period. Company was entitled for buyback. However, the application has been filed after stipulated time. Therefore, credit of the duty drawback was discretionary in the hands of department. Since the claims was to be accrued only after filing application, its accrual will be considered as the year 2002-3. Accordingly, duty drawback rate on the contingent asset on the reporting date period will be realized when the departments create the same. As per this paragraph, you don't worry. Contingent assets are continually to ensure developments are appropriately reflected. If it has become virtually certain, inflow will be arise. Relevant for income recognized in the financial statements when the change occurs. If an inflow of the economic benefits become probable, the entity will disclose contingent assets. Okay, in accordance with this answer is okay. This will be a contingent asset, should be recognized as an asset. Relating the income should be recognized in the year 2-3, not in 1-2, that is in the period in which 2002-3 applies. So summary part is what they're trying to tell. on the 31st of March, the condition may have existing, but they have not filed the application within 15 days. In that case, it will go to discretion. Discretion happened only in the next financial year, not the current financial year. It is probable benefit is there, but the fact that the entity may not get depends on the discretion, and when the discretion came, that is only in the next year. So it becomes virtually certain in the next year. In the current year, it will be accounted as contingent asset. In the next year, it will be recognized as income as well as asset, in fact receivable, so you can take it to the P&L account directly and to the cash account. But as far as current year is concerned, you will be recognizing it as a contingent asset by way of a note. I hope things are clear till here. The pending standards are government grant is there, and then foreign exchange, deferred tax, then three trio, that is the earning per share is there, and then we are having related party transaction, operating segments, and Ind AS 101 small standards, and corporate social responsibility. All those things we need to take it in the we have pending. We can take it tomorrow. So as of now, if you have any questions, you can ask. Contingent asset, because it is probable, more than 50%, less than 95%. That percentages are all guideline numbers. You can't accurately go for those numbers. But here, contingent assets are probable definitely. The events are telling it, so you can go for disclosure only, but not for recognition. They are not virtually certain, they are only probable. Just one question on this. If the application was filed before the year end, then what would have been the answer? If the application was filed before the year end and the discretionary, the result came, the government approved it later, but you have filed the application for the approval before itself, then 15 days within that, if you filed, you had every right to receive. It is not contingent asset then. Hope you're getting the point. If they have filed it earlier, it is an asset. Virtually certain asset, yes, asset, yes. You got the point? Very nice. So this is our target which we have finished. So tomorrow, hopefully we should be able to finish it. We have left with the standards I told you. Government grants, then the income tax, that is deferred tax and foreign exchange, and then EPS, related parties operating segment, Ind AS 101, and small aspects. I'll try my level best to complete tomorrow. Tomorrow also old syllabus will be relevant for initial few hours maybe, after which it will be only for new syllabus. Initial few hours will be common. So we'll stop at this point today. It's exactly 2 o'clock. We are going as per plan. Hope your confidence levels are increasing. Increase your confidence level by solving more problems. So solve the MCQ question. I'll share it in some time. So happy learning. Stay home. Stay safe. Tomorrow we'll see you at same time, 11 o'clock. Have a nice day. Thank you.